My name is Mireya Ramirez. I will be presenting a comparison between SCOR's forecasted performance targets and the company's actual results for years 5 and 6. At the core of our company's strategy were prices. We strived to become the low price leader in the industry. We kept our prices low by offering a simple product with a lower production cost than the rest, which in turn allowed us to offer lower prices. We ultimately saved money on production and forwarded things to the customer. This chart demonstrates the targeted rates and our actual rates for return on assets, return on equity, market share, stock price, unit production cost, and total net income. This broad overview demonstrates that we met and exceeded our targets in just about every factor. Let's analyze each factor more closely. Return on assets. The target for return on assets for year 5 was 16.5, and our actual rate was 18.3. For year 6, we targeted an 11.8, and our actual figure was 34.4. We successfully met and exceeded our expectations for this factor because our low price strategy worked so well that our net income was higher than expected, resulting in a better return on assets. Return on equity. Once again, we see that the actual return on equity surpassed the targeted figure. In year 5, we expected a 23.7, and in actuality, we figured at 26.4. And in year 6, we expected a 16.2, but in actuality got 58.7. We accomplished this by repurchasing over 1 million shares of stock during this time, and once again, thanks to the higher net income than expected, our numbers for return on equity were better as well. Market share. As for market share, we targeted a 21.7 figure in year 5, but in actuality got a 23.5. And in year 6, we targeted a 21.8 and got a 25.5. We reached this number with higher expenditures on advertising than we initially planned. Stock price. In year 5, we anticipated stock prices at $1.87, and in actuality, our stock prices reached $2.71, almost doubling the price. In year 6, we anticipated prices at $2.16 and in actuality reached a stock price of $6.18, tripling our anticipated amount. We achieved this by repurchasing over 1 million stocks during this time, giving our stockholders more confidence in our company. Unit production cost. For year 5, we targeted $4.02 and in actuality was $4.06. And in year 6, we anticipated $4.82 and in actuality got $3.15 unit production cost. In year 5, we were not able to meet our target, but recovered in year 6 thanks to a higher than expected exchange rate. Total net income. Low price competitiveness allowed us to meet our targets and surpass them on both year 5 and 6. We nearly doubled our target net income in year 6. We achieved this by developing a great strategy and the exchange rate being higher than we had expected.
The following section will evaluate the company's performance relative to the strategic goals and objectives outlined in the 2-year plan. The 5 strategic long-term goals were: number 1, to achieve the lowest unit production cost of any team in World 14. Number 2, to offer our customers the lowest price in the market. Number 3, to be the dominant firm in our industry in terms of market share. Number 4, to be extremely profitable. And number 5, to maximize shareholder value. Our first goal was to achieve the lowest unit production cost of any team in World 14. The lowest unit production cost was achieved and maintained in years 4 through 6. In year 4, our UPC was 2.4% below that of our nearest rival. In year 5, we widened the gap to 12.3%, and in year 6, we led by 10%. In dollar values, we were able to reduce UPC by 50 cents or 11%, from years 4 to 5, and by an additional 91 cents, or 22.4%, from year 5 to 6, for an average year-over-year improvement of 16.7%. For the most part, these cost savings transferred directly to our bottom line. We consider our performance in this area to have exceeded expectations. Our second goal was to offer our customers the lowest price on the market. In our 2-year plan, we had intended to cap wholesale prices below $10, but by the end of year 5, our rivals had increased their own selling prices significantly, and we saw an opportunity to raise our prices somewhat without negatively impacting sales and market share. This would allow us to compensate for inflationary forces in the market. Even after accounting for these increases, our prices were still the lowest in all 4 areas. In areas 1 through 3, we were approximately 11% below the average selling price of the other teams, and in Sereno, our price led by a whopping 43%. We do not believe our price increases decrease our market share because our price raises were smaller and slower paced than our competitors, and we always maintained the lowest market price. Rather, the increases improved margins and increased profitability. Our third goal was to be the dominant firm in our industry in terms of market share. This goal was unfortunately never attained, although we did achieve our highest overall market share before the game's end, reaching an average market share of 25.47% for year 6 overall, which put us in second place in that category. Because we did not place any weight on market share as a scoring factor, the goal was actually of secondary concern, and our efforts in this regard were mostly motivated by the corresponding increase in sales and profits. Our fourth goal was to be extremely profitable. Our basic strategy here was to establish industry-leading profit margins so that achieving the highest net income would not be entirely dependent on having the highest sales volume. We attempted to do this by minimizing unit production cost. We produced a minimum viability product with quality and features at 1:1, which kept materials costs low, outsourced more than half of total production to Sereno, and spent consistently on training to maximize worker efficiency. We also employed lean manufacturing principles and minimized our safety stock through accurate forecasting to minimize storage costs. The result of our strategy was that in years 5 and 6, we consistently posted quarterly results in the top 1 or 2 in terms of net income. Although total unit sales volume was typically lower than the other teams, we placed second place for annual net income in years 4 through 6, while posting the lowest gross sales. Our net profit margins increased consistently by 3 to 6% every single year. Our fifth and final goal was to maximize shareholder value. Shareholder value in terms of stock price was increased year after year. Year 5 saw average stock price rise from $1.44 to $2.71 per share, for an annualized increase of 88.2% in stock price over the previous year. In year 6, stocks gained another $3.47, or 128%. Final stock price closed at $6.18 in year 6, quarter 4. Investors enjoyed remarkable gains, and the board is pleased with the stock's performance over the last 2 years. We consider these results to reflect successful performance of the goal of maximizing shareholder value. We also had 5 quantifiable strategic objectives, which were as follows. Number 1, to achieve unit production costs below $4.40 by year 5, quarter 3. Number 2, to keep our wholesale prices consistently below $9.99 per unit. Number 3, to reach 30% market share by year 6, quarter 4. Number 4, to exceed $1 million in net income per quarter beginning year 5, quarter 3. And number 5, to achieve a stock price of $2.50 by year 6, quarter 2. Our second strategic objective was to keep our wholesale prices consistently below $9.99 per unit. This objective was later reevaluated in light of new information. Changes in the competitive market in terms of price prompted us to implement a controlled schedule of gradual price increases to better reflect the market value of our products. This enabled us to maintain our profit margins by compensating for inflationary conditions in the broader market. However, we stayed true to our objective in the qualitative sense, and that we always maintained the lowest competitive price at all times. Our third strategic objective was to reach 30% market share by year 6, quarter 4. This goal was unfortunately never attained, although we did achieve our highest overall market share before the game's end, reaching an average market share of 25.47% for year 6 overall, which put us in second place in that category. Because we did not place any weight on market share as a scoring factor, this goal was actually of secondary concern, and our efforts in this regard were mostly motivated by the corresponding increase in sales and profits that follow with an increase in market share. Our fourth strategic objective was to exceed $1 million in net income per quarter beginning in year 5, quarter 3. This goal was not reached until the following quarter. Our net income in year 5, quarter 3 was only $476,000, less than half of our goal. Although this was disappointing, net income continued to improve, and in year 5, quarter 4, our net income skyrocketed to $1.5 million, well exceeding our goal by 150%. Our total net income in year 5 was $3.5 million for an average quarterly net income of $875,000, which is much closer to our $1 million target overall. Our total net income in year 6 was $5,686,000 for an average quarterly net income of $1,421,500. Overall, our forecast was only off by 1 quarter, and we are pleased with this level of accuracy. Our fifth and final strategic objective was to achieve a stock price of $2.50 by year 6, quarter 2. Our actual stock price in year 6, quarter 2 was $3.92, the second highest among our competitors and far exceeding expectations of $2.50. Our objective was formed based on the average rate of growth in stock price from years 3 and 4 and was wildly underestimated. Year 5 saw average stock prices rise from $1.44 to $2.71 per share for an annualized increase of 88.2% over the previous year. In year 6, stocks gained another $3.47, or 128%. Our performance led expectations by roughly 3 quarters. Our strategy for improving stock price involved increasing net income and buying back shares. In year 6, quarter 2, we had 5.1 million shares outstanding, which at the time was the most of any group.
For our decision-making method, in order to make the best and most accurate decision as a team, we first analyzed the previous quarter's results, compared our results to the industry, and after analytical deliberation, we continued to completing the sales forecast and production plan. Once that was completed, we created the initial phase, which we called the temporary decision. We discussed the temporary decision as a group, and once we reached a consensus, we created the final decision.